Welcome everyone. Oh my goodness, we've got such an amazing turnout. It's so good to see so many familiar faces. My goodness, Doug, great to see you as always. And Jen, oh, Lucy, I see you're connecting to your audio. Oleg, welcome, welcome. Wendy, of course. Wade, thank you. Dawn, you saw us on Instagram just a moment ago. We did a live, so that was awesome. And Sina, I see that you were able to join us. Welcome, welcome. I am Jennifer Hunt. I am the Chief Intelligence Officer with the Real Estate Wealth Lab. And before we get going, I wanted to let you know why we chose that song. So we started our evening tonight with Fleetwood Mac, and You Can Go Your Own Way. And tonight we've got a little bit of a theme about, can you go your own way? Do you want to go your own way? Or how about instead of being lonely out there, come on into our world and into Aurelio's world. And maybe real estate investing doesn't need to be so lonely, and it can be very profitable and fun. So I'm going to introduce Aurelio in just a moment. This is going to be an incredible Market Leaders Lab. But for those of you who are new to REWL, we just want to give you a little bit of sense about who we are. So welcome. If this is your first time, we're so delighted to have you join us tonight. So our Market Leaders Lab event, we have none other than Aurelio Baglione, amazing real estate investor with lots to share. This could go on for hours, but we're going to try and keep it on time, keep it tight. He is the president of Virtus Financial Group, and he has got some things to share with us, ladies and gentlemen, and I am so excited to share them with you. Not only are we going to be talking about real estate investment trusts, but we're also going to be talking about an asset rollover. Before I go on, ladies and gentlemen, please pop it in the chat. Have you ever heard of an asset rollover? I'm waiting. Is my chat? No, look at, okay. No, thank you, Alexander. Thank you, Ari. Awesome. Okay. Anybody else heard of an asset rollover? Okay. Thank you. Duran, no. Ben, no. Awesome. Thank you so much for playing and contributing and being like 1031. I understand. That's a great, thank you, Jen, for that. It's not like that. So that's fantastic. That is in the US. And what we've got today is an incredible tax efficient, which is a 1031 as well. So that's good. But it's an efficient way to create legacy. We're going to talk lots about that. You have lots to learn if we haven't heard about asset rollovers yet. And Aurelio will be walking us through that. So what is REWL? The Real Estate Wealth Lab is about taking your real estate wherever you are, if you're just starting out, or if you've already been doing it for a little while, but you want to go to that next level, or if you already have been investing in real estate for a long time and you want to exit and plan your succession, we have everything you need to take your real estate to the next level. So what we've got right now is just, we're going to share about what REWL is, a little bit about our team. This isn't going to take more than like 10 minutes, so hang in there. And why join our free trial, the REWL membership, our products, and our events. So we are a boutique intelligence agency. We're focused on research, data, analysis, all those fun things, and combining them with artificial intelligence, with industry-leading technology. I mean, this is really incredible. And our proprietary analysis formula, there is nothing like it to be able to create more accurate, more predictable forecasts for real estate cycles and for their duration anywhere else, anywhere. And so this really takes the guesswork out and the uncertainty out of all of your real estate choices. And we also offer very personalized investment intelligence and services as well. So here's our team members. There's lots of us at work behind the scenes. It's an amazing team of individuals. So if you're here, I'm going to call out your names and you can just give a little wave if that works for you. So Richard Dolan is our Chief Growth Officer. Naran, Chief Leadership Officer. I know you're here, just give a wave. I can't see everybody, so there you go. Ken is our Chief Operating Officer, and he's on the line. That's awesome. We've got Vincent, our Chief Technology Officer. Yan, our Chief Marketing Officer. Awesome. And Rob is our Chief Real Estate Strategist. Rob. And Paige is our Head of Customer Experience. There is a beautiful wave. Lovely. Thank you so much for all being here and for contributing to this. Really, everyone here is involved in real estate and is a leader in their own right. So why join our free trial? You know what, I'm going to say that's differently. Why join our membership? Which, for those of you who haven't become a member already, join our free trial right now. So you can become automatically registered to all of our events. I'll tell you what those look like. You can access all of our member portal and our services in our service team, which is very cool. Lots to unpack there, and receive our weekly real estate intelligence newsletter. Yes, that all during our free trial and as a member. So as a member, you're going to get these weekly reports, and they're pretty fun. But what they are is they're telling you what it's research about what's going on in the world, what's macroeconomics, and you might be wondering why, who cares? Because everything that's in that intelligence newsletter matters to you as a real estate investor, whether it's a policy or some form of government change, whether it's a study that's just come out, we unpack it and tell you exactly what it means to you. So then we have expert commentary, the macro trends that are going on in both Canada and the US. This is one of the first North American organizations to do this kind of level of research anywhere. So we don't discriminate. We like both sides of the border. We have monthly live digital events, and I'm going to go into that in a little bit more detail. City-specific analysis. It's great to understand, you know, the Canadian real estate market or the US real estate market. You've got to get into the state and right into various cities. So we've got some pretty cool ones coming up. We've done lots of really good ones on both sides of the border already, and masterminds. So our REWL portal and products, what members actually get. Here's a couple of other components. We have a whole portal, member portal for you, just with so much value. There's you can access the intelligence newsletters, those articles and everything are in there for you. That market analysis is all archived in there. And then really very powerfully, and by the way, all of our presentations are recorded and they're even time-stamped for various topics to save you time and be efficient when you need to go back and refer to something, or if you couldn't make a meeting right by chance. And those calculators, I can't even stress how amazing those calculators are. Anybody here ever done a spreadsheet to analyze their properties or their markets? Pop it in the chat. Use a spreadsheet? Yes, Tara, yes. Every day, Scott, awesome, thank you, thank you. Exactly, and this is not to necessarily, Allison, of course, this is not necessarily to replace your spreadsheets. For those of you who are already next level investors, we know, guilty as charged, we know you've got your spreadsheets that you love. But try sharing those spreadsheets with your potential joint venture partners. That's where people can get lost. So we've created these tools that allow you to very elegantly populate them with the information and data that you have and create beautiful pitch decks and reports and ways to showcase your properties, your investment opportunities without having to show the formula in C13. So we've got you covered there, and you're going to look just like an expert. If someone might help, I think there might be some annotating that's going on, so that would be fantastic. So our REWL products, other calculators that we have in there is Fast Filter, Airbnb. Ever thought of a property is something that you could Airbnb? I mean, it's pretty incredible. So we've got selling your property, you name it. There's all kinds of different things that we want to be looking at. I'm not going to go through them all here, but just know that we've got lots for you. All right. Thank you for your patience. More calculators. So knowing if your portfolio is working, not just on a particular property, but how is your entire property going? And then of course, property analysis right into it. So you'll want to also save the dates. Listen, the long story short here is just come and hang out with us on Wednesdays. That's what you need to know. The second, the third, and the fourth Wednesday of every month, we have an event for you. All of our members get together. We have all kinds of different topics. And on the second Wednesday, that's today, we have our Market Leaders Lab event. Then we follow that with our Community Lab. What's that? Well, Community Lab is about bringing people together to network, to work together, to analyze deals, to play with the calculators, and really have a hands-on, tangible experience. And our research is exactly that. It's where we tell you what's going on in the world, what's going on in Canada and the US, and then drill into very specific cities and markets so that you know exactly where we are in the market and whether it's a buy, sell, or hold signal. Yes, all of that. So our research labs here is a bit more about that. We just had our cutting edge advantage for Ottawa and KWC, so Kitchener, Waterloo, and Cambridge, and we dive deeply into it. So you'll want to come and get those market analyses, and there's plenty of market analysis in our member portal. And you've all joined us. Welcome, welcome, welcome. I can see the number of people coming in. That's still amazing. Thank you. Is our Market Leaders Lab. This is where we get to be on the shoulders of giants and learn from the best. So understanding what smart money is doing, learning from individuals who have gone before us and created amazing products in real estate, how they invest their money, where they invest, what kinds of products do they offer, that type of thing, so that we may emulate them, learn from them, or even join them. In other words, not necessarily going our own way all the time. Freddie's asking analysis reports for Montreal market. It is on our list for sure. We haven't done it just yet. Freddie, thank you. But I will, for anybody considering Montreal or Quebec, just something to note right off the top, want to consider that they actually have a different law. So if you're not already in Quebec and familiar with their judicial system, it is different than the rest of Canada. So just a little note for you to know that. All right, so here's some of our past Market Leaders events. We had Richard Dolan and David Falk. David Falk is a sports legend. He actually was the creator of Space Jam. Anybody remember that movie from 1995? Michael Jordan, yeah, and the Looney Tunes characters. You might be wondering, why would he be on a real estate Market Leaders Lab? This doesn't make sense. No, it does. Because individuals with wealth invest in real estate. And we got to learn and understand how he's investing in real estate, where he's investing in real estate, what specific market and what specific clientele that he is going for. And guess what? A lot of these trends are amazing for us to uncover and to emulate again. Very good. Okay, so our community lab, I think I covered this well. This is really more hands-on and getting to know one another. This is where we put our actions into practice and we get to play with the materials. So again, why join us? Because you get all of what I just discovered and more for free right now. That's for a limited time offer. This is not going to be for forever, so please make sure that you join us now. And also, for those of you who are already a Real Estate Wealth Lab member, please consider sharing us and joining our community and sharing it with your friends as a REWL ambassador. Now, first of all, of course, we want to grow the community. We want to have you involved. We want to have your friends involved and your joint venture partners. But also we want to make sure that you benefit as well. And we've got an incredible offering here that you'll get credits and rebates. In other words, save money by bringing your friends along. So you'll receive a custom link. That custom link you can share with your friends and your colleagues and whatnot and your network. And when they join, it will be tracked and you will actually receive 10% off of your REWL membership. Is that good or good? I think it's great. One moment, please. All right, thank you for your patience. Okay, so here's all the details to join our next event. And you can join us at realestatewealthlab.com. Just one moment, please. Thank you. Apologize for the delay. And I'm actually just going to ask, if you're drawing on the screen, if you wouldn't mind, please just, we appreciate it if you don't draw on our screen. We're going to get off this annotation, and I'm just going to try it. There we go. So if you wouldn't mind, I'd really appreciate that respect for others here, so that we don't have other people drawing on our screens. So thank you so much. Mahalo. So please do get in touch with us at info@realestatewealthlab.com. There is lots to learn. I know I just went through what we've got to offer so quickly here. So please join us. Join the conversations on Instagram at the Real Estate Wealth Lab, and join us on Facebook, LinkedIn, TikTok, all the cool places where people are hanging out these days at Real Estate Wealth Lab. So that's amazing. Thank you for popping that in the chat page. Now, we're going to get into our next segment. And before I introduce our amazing guest speaker tonight, I want to just draw us into a conversation about alternative investing. And I want to have you consider, you may consider how you want to listen to this conversation tonight, because we're going to be talking about some pretty cool ways of investing in real estate. It doesn't always have to be that single family. We want to talk about real estate investment trusts. We want to talk about different kinds of assets, whether they're multifamily or commercial or some pretty big commercial properties, and how that works, how to set up a REIT. So you can really listen to this from a couple of perspectives. Some of you have been investing in real estate for a super long time. You know the value of it. You know that you want to do something with it, but you're kind of tired. And if you're that person, you're tired, or you don't have a successor in your life to take over, this is a conversation that you absolutely must pay attention to and listen to it from that perspective of a don't do it yourselfer. Or for those of you who are just beginning and you don't have a lot of money to invest, you know the intrinsic value of real estate. Also, listen to it from I don't have to go it my own way. I don't have to do it myself. There are other ways to get my money working for me in amazing real estate opportunities without having to do all that work, and to rely on experts such as Aurelio and his massive team. In addition, for those of you who are thinking, okay, but I actually do want to do this myself. I actually want to start a REIT or become an issuer and work through the securitization processes. As a do-it-yourself person, you're going to have a lot to learn as well, because Aurelio is going to be sharing some of his amazing insights on how he set up his fund. So, ladies and gentlemen, without further ado, I'm going to stop sharing my screen and we're going to spotlight Aurelio so that he's front and center. Fantastic. Thank you, and welcome, Aurelio, for joining us. We thank you so much for joining us at REWL.
Thank you.
Wonderful. So, ladies and gentlemen, Aurelio, as I mentioned, is the president of Virtus Financial Group and has been in real estate for a while. I won't say a long time, a very good amount of time with plenty of experience. A long time. And so we're delighted to have you here and share these concepts of your particular REIT and how it works, and also this asset rollover, which is just blows my mind. Amazing. So you're a real leader in the space. You've come up with incredible models, and we are delighted to have you here. So I'd love to turn it over to you to just tell us a little bit about your story in real estate, how you got to where you are.
Sure. I'd love to. I'm going to take a step back just before real estate, and that is I always had pretty high aspirations. Coming from an immigrant household, like a lot of us have, there was two things that my parents passed on to me. Education wasn't one of them because they didn't have any. But they instilled in me a strong work ethic, and the fact that their belief was that each successive generation has to do better than the one before. And so our specific family went from pretty much serfdom subsistence farming to coming here in Canada, buying a home, and then myself being the first in our extended family to go to university. So it was kind of important to me. It wasn't really too important to my parents. They couldn't appreciate the fact that you actually need an education to get by, because my dad managed to do well enough working in construction to buy his home and pay it off in a few years and be debt free. But it was in my second year of university that I spotted an ad in a newspaper. Back then they were paper, and there was a little ad for a joint venture partners required Pizza, which is a franchise chain, as we all know. And it was code word for franchise. It hadn't been popularized yet, that term. And I figured if they were crazy enough to sell a 21-year-old kid a franchise, then I was crazy enough to buy one. My dad wasn't very happy with me when I told him. His view was that people don't go to university to learn how to make pizza. In fact, he asked me, he says, well, if you wanted to make pizza, why did you go to university? And I tried to explain to him the business part of it. And he points to my mother. We were in the kitchen. He says, your mother knows how to make pizza. She didn't go to university. So that was the kind of household I grew up in. But I purchased the store. It was store 47 in 1984. And I bought it for $85,000. I had $20,000 saved up because I worked from, delivering newspapers, selling ice cream with the cart, pumping gas, then working in a warehouse and all that kind of stuff.
Like you said, that work ethic, right,
That
Aurelio?
work ethic, yes.
Yeah.
If you weren't, if you weren't in school, you should be working. So I bought it. I worked over 100 hours a week for 2 years, and I paid it off. After that, I came to the realization. So I always have this belief that, I'm not the smartest guy in the room. And so as I was looking at other franchisees who were 30 years older than me, they were still in their stores. And I thought, I don't want to be that guy 30 years from now. So I sold my store, and I got the proceeds of it. And I had invested in a mortgage that went bad. So I ended up having.
May I just ask a quick question? You
Yes.
invested as in a mortgage, as in being the plain bank?
Yes, I was the lender.
You were the lender. Okay.
And fortunately for me, I was in first place. And the company that was doing these deals ended up being insolvent. So I ended up taking control of this property in Port Colborne, of all places. My
Just
mortgage.
a second, Aurelio. So, ladies and gentlemen, for those of you who are listening, that means that you can become an accidental homeowner sometimes in real estate.
Yes. Well, our laws are structured a little bit differently in that foreclosure is a fairly novel concept here. Before, I would say 2 years ago, it was pretty difficult to foreclose on a property. You had to go the power of sale route, but either way, you had to take possession. And so I found out that this property was rented. I had a $21,000 mortgage on a house that was probably worth around $26,000 or $27,000 at the time. And I was getting interest. So I was getting about $230 a month. But I went down there and I met the tenant, and she was paying $382 a month. So I thought to myself, maybe I should be a owner and not a lender, right? So that kind of got me thinking a bit. I sold it and I started buying real estate. And at first I was buying duplexes and triplexes in Barrie, Ontario, because a friend of mine was an agent in Barrie, Ontario. So I kind of got pulled to Barrie, which was fortuitous because Barrie, as we know, is it's a real place now.
Well, Aurelio, we've done some. I'm going to talk about this just for a moment. So, actually, while I'm talking, Aurelio, could you just turn off your camera and turn it back on just briefly? Thank you. And yes, Barrie is and fortuitous indeed. That is incredible. What happened there, and the market has gone up so well. So you landed in a good spot, and we do the right market analysis for that. But that's now. So this is years ago.
This is
In
years
decades.
ago when the sign said 40,000 people. I remember that. So what I realized though is that it takes just as much time to negotiate at that time $1 million property than an $80,000 duplex. But not only that, sometimes it takes you a lot less time because of the caliber of professionalism of the people sitting across the table from you. So I quickly pivoted away from the single family stuff, and I started buying multifamily and commercial properties. So then we fast forward quite a few years, and I ended up with a portfolio of just over 1,300,000 square feet, made up of retail, multi-unit residential, industrial, and medical office buildings everywhere from, I guess, Kapuskasing to Pembroke in Ontario, down to Florida, where I went down in the, they had that crash in 2009, 10, right up until 13. I went down and I purchased 7 properties. All of them were in some form of distress. And of course, they've done fairly well. I've sold a couple of them since. And speaking of that, last year during the interesting times of COVID in New York State, there was that period where the governor was on the news every night. They were having some huge problems. That was around April. That's when I started negotiating the purchase of a commercial property there. It's BJ's Wholesale Club, which is like Costco. It's a public company, close to 300 locations. So I purchased that last year there. So for me, it's been an evolution, and it led me to form the real estate investment trust. And there's a couple of reasons behind it. Primarily was because I started with limited knowledge, of course. I was 23 when I started buying real estate. And I had obviously limited experience in real estate. I had limited capital. I had limited credit. And I had limited contacts. So I thought to myself,
doesn't sound like anybody else here. Have you ever been through that starting out? Go ahead.
And not the least of which was my age, because unfortunately there is some of that age discrimination when you negotiating or stepping into a meeting and there's a 23-year-old kid there. And not to say that I was any more mature for my age. I just was more of a go-getter. And anyway, back to the investment trust that I formed. I thought if I was able to do all of that from such a limited base, if I start now with everything and everyone that I know, I can replicate that in a fraction of the time. And I can bring along investors as well to participate with me. And they don't have to do everything that I've done. They don't have to make all the same mistakes. They don't have to have all the knowledge I have. They don't have to go to the meetings that I go to or read the articles that I read. I do all of that for me. So they're just brought along for the ride, so to speak.
Yeah. So I think that, thank you for that history. I love how you started out, you know, basically you became an accidental-ish landlord, rental housing provider, but then recognized the benefits of it very, very quickly. And that doing it yourself and then expanding and expanding. I think I just want people to really tune into that concept of expanding geographically and being in different markets and the value of that, to protect, to risk mitigate. But having to do the diligence on all of those markets and all of those asset types, it's a little overwhelming, but you're already doing that, Aurelio. And what I'd like to move us towards, so what we're going to do, just for everyone's benefit, we're going to have a little bit of structure. We're going to talk about your REIT, and what is a REIT, what's your REIT all about, some of the benefits, where it's located, etc., and then how you started it. And I'm gonna time us. We're gonna have 15 minutes, and then, ladies and gentlemen, I want you to be able to pick Aurelio's brains. So we're gonna open it up to Q&A. So I want you to be listening and ready to actually ask questions. You can put questions in the chat as we go along as well, and we'll come back to them. Because we want to really understand your business and what you've been able to accomplish, Aurelio. So why don't you first describe what is a REIT?
Okay, so a REIT is a real estate investment trust. I think a lot of us are familiar with the public ones, which are ones such as RioCan and Boardwalk Properties and Callaway, and you know, there's a few. So it's set up the same way. The structure generally is that each property is owned by an individual entity, a separate corporation that acts as a bare trustee. So a bare trustee is a corporation that has nominal title to the property, but is not the beneficial owner. The beneficial owner is a limited partnership. So the limited partnership is a flow-through vehicle that allows investors to participate in the ownership, in the equity, without any of the associated liabilities, say mortgage debt or litigation, that kind of thing. The level above that is the actual trust, where individuals can buy trust units. Our real estate investment trust is RSP eligible, and it's TFSA eligible as well.
Aurelio, may I interrupt? When you say exactly a level above, it means a level of sort of in terms of the general partnership. It also means for individuals that it's another level of not having to be hands-on. In other words,
correct.
In some ways. So
it is. It's completely passive for the investors. They receive a distribution monthly.
Mm-hmm.
Our current distribution is 75 cents per unit, per year, paid monthly. So that would be 6.25 cents per month. When we started the REIT last year, the units were valued at $10. So that equated to a 7.5% return. They were, all of our properties were reappraised, and between slight appreciation and mortgage principal reduction, the units went up by 66 cents. So the units are currently $10.66. The distribution is still 75 cents per year, paid monthly. Hence, our distribution right now is just over 7%. Our first year return was 14.1%. So 7.5% distribution, 6.6%, let's say, increase in net asset value. So the whole philosophy behind the REIT is that our goal is to distribute 7% cash on cash, and then there's about a 3% baked in mortgage principal reduction every year. That's just based on just amortization. So what I'm looking at is providing a 10% return and not having to worry about appreciation. Obviously, we've been living in an environment where everything's appreciated, and that's fantastic. But we can't bank on it long term. Nobody cares in a recession if if you've got a house worth $5 million somewhere. If there's no income coming in, they're not going to give you a mortgage, right? You're going to have to go to very, very expensive debt, and normally it's game over by then. So the REIT is focused on cash flow and on the purchase end on opportunities. And that's why my properties are all over the place. It's based on opportunity. It's based on the fact that at any time there is a recession somewhere, could be in California, could be in Florida, could be in Alberta. I bought my first multi-unit complex in Alberta in 1993 when Alberta was like a bad word. Nobody was buying it. I bought townhouses, 75 of them for $37,000 each. So,
oh my word.
yeah. So
Opportunity knocks.
yeah, so there's opportunities even now, even in Ontario, there's opportunities. For example, I just entered into a contract to buy a long-term care facility. So it's a seniors residence. I have professional management in place. It's third party. So we've already got a deal worked out with them. But what's happened during COVID is that, as you can imagine, if you had a parent that you were thinking about putting in one of those homes and you read about the outbreaks, maybe you hold on for a year or two, right? And also expenses have gone up because they have to do far more cleaning. They need plexiglass, even, tables for two people, there's a plexiglass. Everything's becoming more expensive. So that's brought the income down a bit, but also it's increased the demand for yield in that sector. So I was able to buy one in a really, really nice town right on the main drag. So everything works. The numbers all work out. I have my own, you were talking about spreadsheets. I have my own spreadsheet, of course. So there's still opportunity out there. You just have to kind of, look for it. We're also in the middle of completion of building 70 apartments in Parry Sound. So these are brand new. We will be finished by the end of this month.
May I ask, so when I'm hearing the long-term care facility and this development project that you're bringing on new apartments, did I hear that correctly?
Yes.
So these are all a part of the Virtus REIT?
Correct.
Okay. So this is important as we think about whether we're wanting to do our diligence on a REIT and to put our money in and invest in it, the don't do it yourself version, or if you're considering doing it yourself. These are things that we need to be listening for. What markets, what asset types, and you're very diverse.
Yes. Well, there is
Why?
there's a method to the madness, and that is I've never been a big proponent to having all your eggs in one basket, because I've lived through the recession in the early 90s, and that is a life changer where unless you live through it, you can't. It's hard to imagine a time where people just wouldn't buy, and we're lenders. So I bought a plaza in Simcoe, Ontario in 1994. And how I knew about the plaza is I actually got a call from CIBC. They had a guy there that was calling landlords to see if they were interested in buying properties they had under power of sale. They were listed. Some of them were listed, some of them weren't, but that's how bad things were. And so when you live through that, you kind of get a little gun shy, and you start to develop a business model that will insulate you against that kind of thing. So another thing we do, for example, is we try and go 5 years on our mortgage debt. And because we have so many properties, it's all staggered throughout. And then there is a bit of a check and balance system, because banks are really good now about making sure that your debt service ratios are okay. So in commercial real estate, it's 1.35, which means that for every dollar of mortgage principal and interest you're paying, there's a $1.35 coming in income. So that's the extra distribution part, right? So it's based on experience, and I don't think, I don't think I'm any smarter than a lot of the kids that I went to school with, but I've got a lot of experience in the field, and I've learned a lot from the mistakes that I've made in the past.
So I love how you were describing this, not having all of your eggs in one basket. And truthfully, I've been in real estate for a long time, and you're one of the only people who agreed with me philosophically, or I guess I agreed with you, in making sure that we have different geographical locations and different types. And I think that that's something that's so valuable about the experience that you just shared of living through it, and not having all of your real estate in one particular location or one particular asset type, et cetera, where it can be really challenging. And that's another way of mitigating risk. And I think that that's incredibly valuable. We talked a little earlier, you mentioned about being RSP, which is actually, I'm going to re-say that, registered funds eligible. So I'd like for you to describe your ideal client. And for those of you who are considering, setting up your own fund, these are the kinds of things that you need to be asking yourselves. And for those of you doing due diligence on a REIT, you'll want to be going, okay, so who is my ideal client, and am I it?
Okay, so the ideal client, theoretically, it would be an individual that believes in real estate as an asset class. And I think we can all agree that it is a hedge against inflation. So when you hear about all this talk about, inflation at 7% or whatever, we all know that real estate's outpaced it. But even if it didn't, long term, we know that the house that my dad bought in 1969 for $21,700 is worth $1 million today. So cars are worth a lot more, but real estate has done its part in ensuring that people maintain their wealth once they get in the game. And so our ideal client would be either somebody who is too busy. There's a lot of people that are too busy. If people in the medical practice, they're working long hours, self-employed are working long hours. I've been approached over the years by various individuals who have come to me and said, hey, can you just take over my properties? I'll buy whatever you want, but just take over my properties. I don't even bother going to collect rent anymore because I don't want the hassles of going there 3 or 4 times to catch a tenant. And we've all experienced problem tenants.
Rental housing provider fatigue, if you will. And we're going to talk about that later. Yes.
So the kind of things that I'm involved in requires that I use professionals. So I do have, for example, in our multi-unit portfolio, we have professional management in place. We also have a super for every property. So I don't get the call. To me, it's a quality of life issue too, right? I don't get that call at 11:30 that the hot water won't come on,
and neither do your clients and investors either. So property management.
And the other thing that I've done is we were talking, you talked a bit about the asset rollover. So my own personal wealth is gradually being rolled over into the REIT as well. And that does a couple of things. For one, I have the same issues as other people do in terms of if I own real estate and I get hit by a truck, are my significant other and my kids going to be able to deal with it? Sometimes the drama of deciding who gets what property breaks families apart, right? So that, but by having it in a trust that's professionally managed, there are no issues. The distributions are made and there's no issues with that. The other thing is it's a moral issue at that point, because any property that comes across my desk, I don't worry about this one's mine, this one's for the REIT, this one's for these guys. Everything gets pooled in. So I had an opportunity, for example, in October to purchase a single tenant government leased property in Timmins, off market, completely off market. The family just had this single asset in Ontario. The rest were all multi-unit residential in Quebec. And I managed to buy it at a 12% cap rate. So that went straight into the REIT. It's things like that should give some confidence to investors that they're in good hands, because my own money's
right. You're putting your own portfolio into the trust.
That's
as
right.
well. Very, very important when you're doing your diligence to actually have those questions in mind for sure. And Aurelio, you're mentioning a little bit. I just again, I want to go back to that ideal client, and what is your minimum investment, and how do you keep people in the, I want you to talk about your actual investment in terms of the liquidity. How do they get in and how do they get out? Those are important questions from anyone's perspective.
So the minimum investment is $25,000.
Okay.
And we do have a liquidity feature.
Okay.
Basically, it is for the portfolio, it's $50,000 a month. So if you had an investment of $50,000 and you wanted your money out, you would get it out within 30 days. If there was two of you that wanted $50,000 out, then you get 25 each per month for 2 months. Just so that I provide some clarity, we haven't had any redemptions to date, which is a good sign.
That's a very good indication.
Yes.
Of performance. So that's fantastic. And it's because that's a question that people often have. I love it. Okay, Nick, you're asking some great questions. So on that note, because I've got lots of questions too. I could go on for forever. So what we'd like to do is, unless there's anything else that you'd like to say, one more thing about it, and then we're going to go into questions and answers about the REIT. So if you had one more statement that you'd like to make about it.
Yes. So because this is my chosen field, I'm kind of like a big believer in getting as much information as I can from as many sources as I can, and including people in my industry. And then, it kind of filters down and you have to make a decision. There was a very interesting article in the Star on the weekend that the Ontario government, they miscalculated how many housing units they needed. I don't know if anyone else has read that, but they're short 120,000 rental housing, right? So it just went to confirm what we already knew, because wherever we went, so the first thing we do is we go into a small town where we have a property already and we're going to build an apartment building. So we go into the social services office and we ask them, what's your rental apartment situation like? And typically it's somewhere between 300 to 500 families waiting for an apartment to come up. And then we have an idea of what the demand will be like. So when we started our project in Parry Sound, we were targeting a rent on a 1-bedroom at $1,100. So we're currently getting $1,550 a month. And when those come up again, they'll probably go up to $1,600 or $1,650. The reason they're $1,550 now is because we want to fill the building. Then as vacancies come up, we can fine tune it a bit. But that is why we're also building in Simcoe, Ontario. We have approval for an apartment building there, and another building in Angus. So just how things kind of go around, where I started in Barrie in 1986, and now I'm back on the south end of Barrie many years later, this time in Angus, which is just southwest of Barrie. It's kind of in their
Close to the Simcoe County, if you will.
Well, no, it's exactly. Yeah, exactly. Yeah.
Awesome. Okay. So we've got some questions in here. So thanks for popping them in the chat. And I'm going to start with, so from D. So anyone can start a REIT in addition to buying real estate? ? So I'd like to just clarify that. First of all, yes, almost anyone can invest in a REIT as well as buying your own real estate. So there's that. But can anyone start a REIT? And what does it take to start a REIT, Aurelio?
Okay, so starting a REIT is like starting any other investment. So they're referred to in the securities industry as issuers. So you can be an issuer. You need an offering memorandum. So you need to go see a lawyer, and they need to prepare offering documents. If you're going to make it RSP eligible, then you need to get a legal opinion. To keep it RSP eligible, you need a minimum of 150 investors.
Just everybody, if you're thinking of having a REIT, you need a minimum of 150 investors. Is that what I heard?
To make it RSP eligible.
To make it RSP eligible. Excellent. Thank you for the clarification. Thank you.
So if you're not going to be dealing with the public, so if you're not going to be selling units through the public, to the public through a dealer, so all units have to be sold through an exempt market dealer. So fortunately for me, I own an exempt market dealer, not a coincidence. There are easier ways of forming an investment club than that, unless you are going to be taking money from the public.
Excellent. Okay, that leads us to our next question. So and we're going to get right into this because I want to know, and so does Nick. Thank you for asking the question. Wendy, I see your hand up. Would you mind popping it in the chat, and I'll try to catch up? Thank you. Because there's lots of questions up here in the chat. So from Nick, what's the approximate cost per unit to maintain and manage the REIT? So for example, legals, management, accounting, audits, and maybe let's start with the cost that it takes to set up, and then the cost to manage, so that we can maintain and manage.
Okay, well, if you wanted to just start a REIT, not make it RSP eligible, you're probably looking at about, I would say, 100,000 for an offering memorandum by, a decent sized law firm. And then of course your reporting requirements and things like that's on an ongoing basis. Audited financial statements, we do them every year. Sometimes
accounting fees.
Right. So we do all of that internally. It's all baked into the return. So the investors actually don't pay for it from their distribution. It's already paid for prior to that distributed amount.
Beautiful. So if one were to start up a REIT, need at least 100,000 for the offering memorandum, quite a bit of money for accounting setup, corporate setup, probably in terms of setting up the actual trust, I would imagine. Right.
So the only reason you would set it up like this is if you had access to raising money from the public. Otherwise, it really doesn't make sense to start a REIT. You can have a limited partnership with you and your friends. You can have a corporation set up with people being shareholders. There's a lot of structures that are a lot cheaper than, and the only reason you need an offering memorandum is because that is a disclosure document to the public to protect them against the guys wearing the black hats in town. So yeah, I wouldn't do it unless I had access to many investors.
What do you think would be the minimum size portfolio, assuming that someone does want to set up a REIT and start growing and expanding and for all the reasons you just mentioned? What do you think is the minimum size portfolio that would be worthwhile to even consider starting a REIT?
Well, we're looking at in our case, our minimum is about 100 million in terms of properties. And that gives us the scale and scope that we need, and it's also worth our time and attention doing it. Right now, as we speak, we're at 30, but that's pre-rollover. We have assets being rolled over in March, April that will take us to about $130 million.
Oh, right on.
Those are already assets that we control. So it's not an if, it's a when.
And that is very important. It's not an if, it's a when, because you already have those assets under control, and it's just a matter. And we're going to talk about the rollover. So I want to make sure a couple more questions. Paulo asked, is it only for accredited investors? So to invest in your REIT, do you need to be an accredited investor is the question.
No, you don't. There's you can be an eligible investor, which is somebody who makes 75,000 or more and has 400,000 or more in assets. Where it gets a little bit tricky is with concentration rules based on the guidelines of the securities industry. You should not be putting more than 20% of your financial assets in any single class. So if you had, say, $100,000, you might want to put 20,000 into the REIT, that kind of thing.
Aurelio, thank you for bringing that up, because this is something that gets confused, in my opinion, in a lot of different places. And so thanks. Let's clarify this. So concentration rules, and I'm not an EMD, but you own one, so you'll be able to fix whatever I'm saying too. But as an exempt market dealer, there's what's called dealer representatives, DRs, if I'm correct, something like that. And then they go and they are able to sell the product, the offering. And it's their job to do that. But in order for them to sell it to someone, they have what's called a process called Know Your Client. A lot of industries say KYC, I think. KYC, Know Your Client. And in that Know Your Client, my understanding is that even if you're accredited, even if you're in the eligible, even if you're a gabillionaire, there's only so much percentage of your gabillions that you can place into any one particular offering. And is that correct?
That is correct. It's an industry-wide guideline, and there's people that obviously bend the rules. Fortunately or unfortunately, we're not one of them. So we do a complete KYC, and all of our dealer reps have to pass a KYP, Know Your Product test. So because if they don't understand it, they can't explain it.
Perfect. I hope that clarifies for individuals. That's thank you for bringing that up. I've got a question from Allison, and she's asking, basically I'm going to summarize so your REIT currently has US and Canadian properties.
Yes.
Would you, or are you open, or are you set up to have international properties? We've got lots of individuals who are interested in, Costa Rica, Panama, Caribbean, etc. And just curious to know if your structure allows for that.
It would, but we're not going to go there. I think the US and Canadian market are big enough. And at my age, I don't want to learn another market.
And not even just another market, another country with entire sets of rules.
Right. It's not even about the market itself. It's about the laws. What laws are set up there to protect an absentee landlord. You hear horror stories about, local guys who will take over because they're local and they know everyone. So we're going to stick to Canada and the US.
Okay. Very good. Thank you. And that's cool to know that your structure would allow for it if you wanted to, but so that's helpful just to understand the REIT process. Julius is asking, are the investors in REIT members in REIT of the LP? Oh, so are they members of the limited partnership, are shareholders, or of the trust? So in other words, are they in what are the investors called? Are they just investors? Are they limited partners, or are they shareholders?
They're unit holders. So they get a certificate for their number of units, and that entitles them to their share, which is the same as one limited partnership unit of the actual total. Now that total changes every month as new investors come in. There's actually like more units, but then we have cash to go out and buy other properties. There's also the DRIP program, which is direct reinvestment program. So if
you offer DRIP,
right? So if you had $100,000 and it was generating $625 a month, you could, that money, that $625 would be used to buy 62.5 units every month and compound every month, because then those units would make
and start accruing and accumulating.
Exactly.
Fantastic. You know, I hope everyone's listening for like all of the things that you would need to consider if you were going to set it up. There's a lot of infrastructure in the works to do this, so it's a lot of work. So there's also, again, don't go your own way. I can't sing, but anyways, there's real value in, again, leveraging someone else's experience, the infrastructure, rather than setting it up yourselves. So we have a ton more questions, but I do want to be respectful of time. So I'm going to have, this I think is a very good one. And then we're going to switch over to the asset rollover, because I know we absolutely have to learn about that. It's so incredible. I'm so excited. And then we can come back. We'll have lots more questions, and we can stay for a little while longer. So Jennifer is asking, what did you say the term is for the REIT? Was it 3 or 5 years? And again, maybe just reiterate, what are the penalties for early exit? Because that's a very unique component of your particular REIT.
Right. So the REIT, there is no term.
Did you hear that, everyone? There's no term.
No, I mean, what I should say is that the REIT is set up to go into perpetuity. I think we have to renew the trust every 20 years or so, but there's no time period where we sell everything off or whatever. That's not the point. This is supposed to be set up for intergenerational wealth transfer, right? There is, depending on your dealer rep, if your dealer rep chooses to, so dealer reps are sales commission people. So if most of them choose to take their commission on a yearly basis, like a trailer fee, in which case the fees for exit are minimal, if any. I'll have to confirm that, but where there would be one is if you were tied up, say, for 5 years, and then your dealer rep would get paid his commission for 5 years, and then there would be a fee to compensate the dealer for paying that. So the fee the first year, like if you bought today and sold tomorrow, it might be 5%. If you sold in a year, it would be 4%. If you sold in 2 years, it would be 3%, that kind of thing, on a diminishing basis.
Okay, that's for sort of the disposition, if you will.
Correct.
Yeah. Okay, and that's very interesting that it goes down over the duration, because often disposition fees start at 5% and they're just 5% across the board. So that's interesting.
In most cases, though, they would be negligible anyway.
Yeah. Okay. So we have one more question. I think this is really important with regard to the REIT. And what are the decision factors, in your opinion, that people should have when comparing REITs? What are just some of the key things that come to your mind after having created one and running one?
So most REITs out there are very single-minded. So you can buy a commercial REIT, you can buy a Northern Ontario REIT, you can buy a retail REIT, you can buy a multi-unit residential REIT, strictly industrial. So those ones, they sound very sexy, and I'm sure to a lot of people they are, but they're single-minded. And my belief was that if I was an investor, I wouldn't want to make that decision of how much of each I buy, because that's what I'm paying the expert to do for me. I want, I go to the doctor. I don't want him to ask me, what do I think? I'm going there because I think he knows more about it than I do, right? So my REIT is set up more of an opportunity fund, so to speak. And what we look for is kind of holes in the market, because I believe that where you make your money is on the purchase. The rest of it, it's going to do whatever the market does. We don't have control over the market, but we do have control over targeting and purchasing.
Yeah. And what you do with it and the clients that you have, the tenants, I should say, that you have in there.
Exactly. Yeah. The redevelopment, we have a pretty big team here. I have in-house lawyer. I have in-house accountants, of course, and we have our own in-house management team. I have 2 guys on the road that provide supervision, management, going to properties and dealing with leasing and construction and all that other stuff. And then we have third-party management that we use as well. Multi-unit family is a little bit more intensive, so we don't do that from here. We'll use local, and anything I've bought in the States is single tenant. It's just single tenant, net lease. The tenant does their own management, and all I see is a wired deposit into my account every month.
Right. And so in other words, a commercial lease where they're dealing with all of that.
Exactly.
Yeah, perfect. Okay, well, thank you for answering that. We've got lots of questions now about the asset rollover, and listen, this is really cool. So I'm not gonna say anything about it. I'm going to let you explain it, and then we're going to get right into it. So what the heck is an asset rollover anyway, Aurelio?
Okay, so I noticed previously you had mentioned a 1031 exchange. So a 1031 exchange in the US allows you to sell a property, and then you retain an exchange agent. First American was a title company. They're an exchange agent. One of the biggest in the country is a company called IPX. And so when you tell them that, you sign documents along with a direction, and then on closing of that property, the money does not go to you at all. The money goes straight into escrow of that agent. I know this might be too much information, but if you're thinking of investing in the States, it's a good thing to know.
Well, and that was someone's question, was the 1031. So if you can relate that to the asset rollover, it's going to be perfect. So okay. I'm with you.
So there's specific rules on the 1031 as well. So for example, you have 45 days from the day that you sell your property to target 3 properties. So you actually have to list property A, B, and C. Only 3. If you decide that you found another one on day 47, you're done. You can't buy that one. You got to buy one of the 3. And so you have 6 months to close on one of the 3. And you have to use all of the money from your sale for that purchase. And you have to buy a property of at least equal or greater value. So if you sell for $4.5 million, you have to buy at least $4.5 million. So that's a 1031. And I know all of this because I just did one. So there you go. It's fresh. The asset rollover. So how this came about was the fact that myself and a client have real estate, and we were hesitant to leave it to our kids. Not that I don't trust my kids, but my kids don't have the same upbringing as me, and my kids don't know what I know. So I wanted
Anybody
to.
else here have that problem with your children? A problem. It's not a problem, but that consideration with your children, you know. So
So
listen
I
up.
was so I was trying to come up with a structure to protect them in case I'm not around. And I thought, okay, I've built a really good team here that will continue to do what what I've set up here, whether I'm on a beach or whether, I'm being hauled around by six burly men to the nearest, land plot, right? So um, we retained an accounting firm, and there is a structure whereby your equity gets sold to the REIT, and you as the investor take back a promissory note. So now the REIT owes you the money for that equity that you've put in, that you've got. Then the REIT pays off that loan by giving you units. So if I sell a property for $5 million to the REIT, I get a promissory note for $5 million. And then the REIT turns around and says, hey, we want to pay that off. We're going to give you $5 million worth of REIT units. And then you're a REIT holder of $5 million, and then you get distributions. So my point is, if the distributions, let's just say for the sake of argument, they're 7%, and I leave, say, $10 million, then they're going to get $700,000 a year, or about $60,000 a month to spend without dissipating the asset. And the asset's still going to increase because remember, the mortgage is still being paid down every month. Inflation is still doing its thing, whether it's 1% or 5%. So they're not going to dissipate the asset by spending the distribution. And I don't know about anybody else's kids, but I'm pretty sure if you give most kids money, they'll find a way to spend their way through it by living a better lifestyle. And you can't blame them for it because, I don't know what I would do if I was 30 and I had money coming in every month for nothing, right? So it's to protect them and more importantly, to protect my grandchildren, because I want these units to be set up in a way that they're not able to be liquidated. I'm retaining legal counsel now to have a special series of units that have no liquidity feature at all. And I'm not expecting this of any investors, but I'm doing it for myself and a few people like myself who are in the same position.
Yeah, 100%. First of all, I just want to take a little moment here to check in with everyone. We've got so many people on. We're so delighted to have you here. If you're getting value out of today's market leaders call, I mean, this is pretty intense. There's a lot going on. Please join us. Please join the community. Real Estate Wealth Lab. We're going to pop the link in for our free trial right in the chat here. Thank you, Paige, in advance. And and stick with us because we are just getting started. So Aurelio, back to, I'm just going to also, thank you. We welcome you to the community. And Aurelio, I'm going to try and summarize what I understand of that asset rollover, and then we're going to dive into some of the details a little bit. So my understanding is if there's a certain number of properties, and I know you've got criteria for what those look like and the amount and whatnot, that we don't want to manage them anymore. We don't have the right succession plan in place, but we know the value of real estate. We know that it's going to be a great longevity play, a long-term wealth accumulation for us, for future generations. And even if you don't have kids, for charity or whomever, I mean, whatever meaning you want to ascribe to it, you can take that and your REIT, your REIT, will purchase the equity and give you a promissory note for that equity, and that ends up converting, so that basically you take over the control of that property and the individual gets an equivalent of units in the REIT.
Yes. So there is and I'm reading some of the questions there, and they're well thought out. And that is, there's no such thing in tax law for a loss if you're not actually losing money. So this is a deferment. So your cost base is whatever your original cost base was when whatever you bought that property for, that's the cost base of the units that you're getting. So you will get a capital gain upon disposition. And in order to deal with estate planning and stuff, you really should be talking to a lawyer that does that. We're in the middle of setting up an estate division as well, where maybe we can guide some of our investors through, since I'm going through the same process myself. So there is that. One other thing that you need to know about the REIT is it is preferential deferred income. And that is, if you put your money, let's say you lend your money out on a mortgage and you get 7%. 7% is taxable. So you would pay tax on 7. If you got 50%, you lose 3.5. In our case, because we use depreciation, capital cost allowance, on average, you're only going to be taxed at about 45% of the 7%, which is really good when you consider that if you're earning 10 or 12 or whatever rate it happens to be, you're only going to be taxed on about 45% of the 7% distribution. The rest of it is a return of capital, which does lower your cost base. So it is a deferment, right? But the whole idea is, if you buy into products while you're still working, then you don't have, you can make it tax efficient. And then if you start pulling money out when you're retired, when you're not working, it becomes easier at that point. And let's face it, if tax is your only problem in life, you're doing pretty well. Right?
Right? Those high taxes is actually a good indication.
If you're not paying any tax, there's probably a really good reason for it, and maybe you shouldn't even be listening. So yeah, it's a good problem to have, because it means that you're actually successful in what you're doing.
Yeah, absolutely. So tax efficient, but the deferment on some aspects. Okay, so what are your criteria for accepting, like what kinds of properties would be eligible to roll over into your REIT?
Well, preferably properties that meet our criteria, and that is they're cash flowing in a growing market. All the usual criteria that we would apply to a new purchase. If they don't fit, we can make allowances and hang on to the asset for a moderate amount of time, and then sell it and convert those funds to a cash flowing producing asset that does meet our criteria.
Oh, wow. So it sounds very flexible.
It is, in that we can make it work, but given the amount of let's say of effort that it's going to take to put everything together, we'd be only dealing with individuals that had a fair bit of equity in it.
Right.
So
okay. So you're going to take a sort of a formula of equity as well as cash flow, because Naran's asking a great question of how much cash flow would the property need to be generating in order for you to consider it?
Well, that's a touchy-feely thing. Different asset classes demand different. So multi-unit residential right now, is the cap rates are crazy low, which is why we're not really buying them or building them. It's cheaper for us to build them now than to buy them. Whereas in some of the other markets, let's say retail up north right now, the cap rates are higher. So it's really, we'd have to do our own analysis on it and treat it like a new buy. And it might not, it might be a situation where we have some kind of a compromise in terms of value. But what the investor has to remember is that I don't think they would be wanting to be an investor in a company that just bought stuff willy-nilly. It's not a good sign.
Correct. Definitely not. Yes, very well said. So there's definitely a diligence process that you employ, and you've got criteria and you have exacting standards. However, there are other factors, and I love this because there's just so many indicators in various markets, in various asset types, in various niche markets with niche clients that you've established the infrastructure to be able to truly ascertain if this is a good deal or not. And like you said, you look for, I think you used the word holes in the market, those niche areas. So it sounds as though there's a lot of people this could be a broad opportunity for individuals.
Agreed. And being an investor, I think you would want us to do the right thing. And you want to make sure that all of our properties are sustainable and cash flowing. And that's kind of our job, right? It doesn't matter where where the property comes from, that the criteria has to be met.
100% sustainability. All right. Well, I would like to turn this over to, thank you for describing asset rollover. I mean, this is really very, very cool opportunity for individuals to consider. So yeah, whether you're tired or you're exiting or is trying to plan your estate, this is an excellent option. And I've never heard anyone else offering it. So Aurelio, kudos to you and your entire team for creating this and making it available as a solution in real estate investing. So kudos to you and your team. So now we're going to open it up for Q&A on any component, whether it's the REIT or the asset rollover. What are your questions? What do you want to know? And I do have a couple of questions that were earlier, so pop them in the chat.
Or real estate in general. I remember you might not know this, Jennifer, but when I started, there was a guy on TV named Ed Beckley, and he had a seminar series about buying property, no money down. And then there was the Raymond Aaron seminars in Toronto, where he was going around and giving lessons on how to buy property with low money down and what to look for. So I did all of that. So I actually am a student of real estate, not just a trustee and a securities market dealer. I'm still a student of real estate.
Amazing. And being a lifelong student.
Yes. The name of our REIT, I saw one of the questions, is the Virtus Real Estate Investment Trust.
Awesome. And for those of you who are curious to learn more, who are maybe even ready to, yes, this is the solution I've been waiting for, please definitely email us at info@realestatewealthlab.com, and we are going to make sure that you get everything handled. We'll be getting you in touch with your entire team, whoever we need to direct it to on your team, Aurelio. So info@realestatewealthlab.com. If you want to get involved in the REIT, or if you want to learn more about the asset rollover, whatever that looks like, we'll pop that in there. There, thanks Paige. So there's the email. So wow, there's lots of questions going on here. Actually, I wanted to go back because I thought that this was a very good question. I think it was from Leanne, and they asked if they would hold, so assuming that they bought into the REIT, would they hold the units personally or in a corporation for that succession planning and generational wealth? What's your recommendation?
I guess it depends. If it goes into a corporation, I suppose it's easier for succession planning because the shares can be assigned. The thing that you have to kind of be cognizant of is if you need the money, like if you need to spend the money. If it's in a drip, I guess it doesn't matter. But if you need to spend the money, then you would have to first deal with the corporate tax and then put it into the personal and deal with it there. It's a little bit more complicated than just putting it personal. But if it's for succession planning purposes, it's probably easier to do it that way. If it's done specifically for that, and you know you're going to do it, then you
For succession planning, specifically for succession planning?
yes, if you know for sure, then you can set up a trust for whomever, your kids and whatever, and then the trust would own the units, and then the monies could be in a drip program and keep building, and then you could put whatever conditions you want on the trust so that when your kids are whatever age they are, they get a right to say take the distributions but not sell the units, or sell only so many units per year. Whatever conditions you want to put in the trust is going to govern it.
What you are saying is incredibly important for estate planning. And for those of you who are thinking about this, I love even this question because, and you said it perfectly, Aurelio, is it's all well and good to put, buy it in a corporation, but if you need that money, how do you get it out? I mean, in some cases you can't, or in some cases you can get your own dividends out and whatnot, or if you want to use it personally, depending on how much you need. There's kind of, and of course there's ways, and I'm not an accountant and all of these kinds of things, but it becomes a layer of complication. And where this idea of having a trust in a trust gives you the flexibility to have those distributions, going to your family. So well said. Thank you, Aurelio. Appreciate that. We've got another question is, what other products do you have on the shelf?
Okay, so I'm going to assume that these are proprietary products. So I'll just define that. As a securities dealer, we have various products on our shelf. We're not the issuer of all those products. Our proprietary products are products such as our Reit. We have a MIC that we just formed, which is an investment mortgage investment corporation, and that literally was done last month. We got our
congratulations.
Thank you. Thank you.
And may I just I'll let you continue. Just for those of you who may not know what a mortgage wow, now I just lost it. Investment corporation is a MIC. That is where individuals pool their funds together, just like what Aurelio has been doing with the REIT. But the lending, the mortgage loan goes over multiple properties. So again, not just, a syndication would be sort of multiple investors or lenders on one property typically, whereas a MIC is on multiple people, multiple properties. Did I get that right, Aurelio?
Correct.
Awesome.
So we have that as an investment. We have a bond, and we also have something called a tax-assisted real estate investment, and that's for investors that wish to. Normally, they're higher income, and because remember, it's know your client, right? So higher income individuals, and they can use their tax savings to help fund the purchase of property.
Awesome. Okay. Any other questions? I want to be mindful of time. We've had a fantastic hour and a half already. We do need Ken, we need another talk just on that. So we'll need to have you back, Aurelio, and discuss some of these other, understanding what MICs are and how to invest in them, and why would we choose a MIC over a REIT? This is it.
My dad. So my dad, who is in his 80s, and value and very exceptionally conservative, he would invest in a MIC before he invested in a REIT. And it's about suitability, and no matter how good the market is, if there is a shift in the market, landlords will face the perils before the mortgage lender who's at 70%. So that cushion, that 30% cushion of equity is what protects the MIC. And that's why the yields are less. So our yield in the MIC is 7%, but that's all you ever get is 7%. However, you do have that cushion of the homeowner's equity.
Yeah. Okay. And I love this. So even knowing your level of conservatism versus your risk versus your timeline and what you're wanting to accomplish out of it. I see Jennifer's asking about, and I hope I'm pronouncing that correctly, talk about the bonds.
Well, the bond is another vehicle that we have. So it's connected to the tax-assisted real estate investment. So what we do there is we lend investors the money to buy income properties, and then they use their tax savings to make their payments, along with the cash flow on the property. So it's a very tax efficient vehicle. It does have a time horizon of 15 years because that's normally how long it takes to pay off the debt. We take those notes, those promissory notes, so these loans that we've made to investors who are primarily, I would say 90% of them are in the medical profession, and we securitize that and issue a bond. And we do it in the form of, for every $2 of bond issue, we have $3 in notes. So we have a debt service coverage of over 200%.
Wow.
And a asset coverage of 150%.
Wow. Thank you for sharing that. And we will have, Jennifer, you're going to have to come and join us for our next call. We'll do a deeper one of the calls in the future. We'll have Aurelio back and talk more about the bond, and we'll talk more about the MIC and how to choose between all these amazing products and why you would consider them or when they're good for various people in their journeys. I think that's pretty good. I want to be respectful of people's time. If you have more questions, you can pop them in this chat. I don't know how you're doing for time, Aurelio.
Hey, I'm in my office. I'm used to it here, very comfortable, which is why I picked it, because this is where I do my work. So awesome. I'm in work mode here.
Okay, fantastic. Well, I see this question from Eric is, I have a question. What website do you use to find multifamily buildings? And I think you've probably got a pretty good answer for this one, Aurelio.
What website do I use to
find your properties?
Oh, I get calls. So I would say 90% of our properties are unsolicited calls I get from realtors or somebody who knows of somebody who's in financial problems, or sometimes it's just age. You know, guys who are wealthy, they reach a certain point in time where they don't want to deal with running a mall anymore. So we get the call and we work out a deal. But I don't, there's no, normally the kinds of deals we get are not normally available to, let's say, the Google Meister out there.
Yeah.
Yeah.
And why I really value that question, Eric, is because it's an important question, and that especially in the commercial real estate world, multifamily, residential, industrial, commercial, it really is about your relationships, and it's about having individuals in the field and getting them before they go on to the various listing sites. You want to be in the game and have that power team set up. So, and you're just proof of exactly that, Aurelio. So thank you for that.
There's also, I'll just elaborate a second, in that most of the top agents in the commercial world, there's probably only about a dozen guys in Canada who are like the all-stars in the commercial world. So their time is very valuable. So when they're going to invest time in speaking to somebody, they want to make sure that that person has an ability to close. So there's no tire kickers, right? So when I get the call, it's because they know that I know what I'm talking about. I'll give them a yes or no in 5 minutes. And then if it's a yes, then they can ship me all the information. It comes to my team. We do what we got to do. Then we drive to the property. I got to walk it myself. I got to talk to people, all that kind of good stuff. But they know that I can close, and it saves them time.
Right. So that's another thing, is building that reputation of work ethic, of having a systemized diligence process, of being able to close. All of those things are going to bring deals to you, and having that reputation. Thank you. Nick, I want to get to your question. So I'm going to read all of it because I want to see this. So you seem to have many branches to your real estate offering: the REIT, the mix, the bond, etc. Every branch and division requires attention and time. Nick is a fan of being focused and keeping it simple. So is the return of all of the branches worth the time and attention required to maintain this level of complexity in your structure?
So for every investment, I have a team. So on the mix side, we have a partner who's been a mortgage broker for 30 years, and he runs the underwriting. We have an in-house person here as well that overlooks the underwriting, and I sign off on every deal. But that takes me very little time. Basically, I've got a due diligence report in front of me. I read through it. If it makes sense, I sign off on it. So I'm a believer as well that you have to specialize in what you do best. The one thing that they all have in common is real estate. So I do have an inherent, I guess, knowledge in certain values. And so that I can transfer across the board. Right. The bond is just a consequence of monetizing our ability to help investors buy real estate. So that's an easy one. That's just paperwork, right? The trickiest one of all, of course, is the REIT, because it's a living, breathing thing that keeps getting bigger and has to perform. We can only rely on ourselves. It's not like a mortgage where the guy's going to take on 3 jobs before he loses his house. In the REIT, we're that guy. We're the ones who are doing 3 jobs to make it work, right? Which means we have to redevelop properties, which is what happened in Perry Sound. The government decided they were going to move the highway. And so I ended up with the Perry Sound Mall.
Wait,
that is
move the highway?
Yeah, Highway 61 used to go right in front of the mall. They moved it. So the commercial node moved over. So where the new commercial node is now, there's a Walmart and a Home Depot. But I lost my Bell store, my Pearl Vision, my supermarket, all of those guys. So what do? Well, you build multi-unit residential, right? So that's the kind of stuff that you do if you're in it every single day. You know, this is kind of like my life.
Well, and it sounds like it's your life, and you have a very large team to support all of these various functions. And one of the questions is actually, where does the cost to have these teams running the company, the management, etc., come from? And is it just from the cash flow from the properties, like for example in the REIT or in the MIC or whatever have you, or are there fees charged for entering the REIT? So that's a question on the floor here.
Sure, that's a fair question. So what you have to keep in mind is when you're managing commercial properties, there is a management fee. Whether we do it or whether somebody else does it, there's a fee. Nobody's going to manage your properties for nothing, right? So we charge a management fee. It varies on the property based on the complexity. So it is between 3.5% and 5% of the gross revenue. If it is a fairly simple property, it's 3.5%. If it's like a mall with 50 tenants, it's 5%. So those property management fees and we have about 40 properties. Those property management fees pay for the infrastructure. That's what drives, all the back office stuff is
Right.
the property management fees. We like to do it ourselves because we have ultimate control over it, and we're very good at it.
Right.
We've also done it. We're also doing it for a couple of other third-party clients because they like the way we run our properties and they want us to run their properties the way we run ours.
So that is very important to know. So thank you. And this is where sort of getting these, I guess if you will, verticals and stacks and organizations that really all have synergies that can work together to support, like you say, the infrastructure. So for the most part, because you also have property management, and property management is a key component of all of it, that's an area that can basically absorb and pay for a lot of, like you said, the infrastructure, the human resources, etc.
Correct. And we talked a bit about, what it would cost to start a REIT and run a REIT and whatever. So just to give you a really small example, our software, we use Yardi software. So the licensing alone is $40,000 a year, and then you have to pay per user. So unless you have scale, it doesn't make sense for you to, you're basically reduced to Excel and QuickBooks at that point, right? So that's what I'm talking about when I said you need like $100 to $130 million worth, because it makes sense at that point. You can afford to be at a certain level of sophistication. You can have your in-house lawyer so that if you have any problems with tenancies, etc., you don't have to go and pay $600 an hour to a downtown firm.
And they're intimately involved in your business. So there's no catching up to speed or, involvement in other cases or anything like that by having that in-house. It's interesting that you mentioned 40,000 just for the one software piece, if that's what I heard.
And that's per year. It's 40,000 a year. Yeah,
yeah.
For the use. Yeah.
Yeah, and I've heard, some kinds of, when you're talking about scaling, and some of the software solutions that are required in order to manage these types of things are hundreds of thousands of dollars to implement, let alone, or, if you've got to tailor make something or, whatever have you, let alone all of the continuing fees. So it is very cost prohibitive to get started.
Yes, and then you have to you have to have your staff trained, right? So that's not including the downtime of your staff actually going through training modules to actually learn how to use the software.
Right, and then creating the operating manuals and the operating systems and the how to do all of those manuals as well, and then actually training them. So yeah, so it is doable out there, folks. That's next level stuff for sure. And you're in the right conversations to learn, how it's done. So I really appreciate your transparency, Aurelio, and being able to share with us, some of those details, so that, if you're thinking about it, start, planning for what that could look like. And if you want to do it yourself, and if you don't want to do it yourself, DDIY, you're in the right spot also. Come on over here, check us out, info@realestatewealthlab.com if you want to learn more about anything on Aurelio's Virtus shelf, and we'll get you in contact with the right people. Nice to see you, Brian, person. Great to see you as well. Really great to have you all here. I think, just in interest of time, this is amazing. We could go on forever. I think we need to have another one and have you right on back. So Aurelio, any closing remarks or anything that you'd like to share about our conversation today? Sure.
First of all, I'd like to just acknowledge that this learning, I went through the same experience as I mentioned. And the beauty of real estate is that the market is big enough for all of us. It's not a competitive market. I work with other landlords. We're part of a fraternity. We help each other. This is not, there's no competition. It's big enough for everybody. We don't compete, on properties or whatever. We don't have to. I just want to welcome everyone to our real estate world and wish everyone the best.
I have one more question for you because of what you just said. What is it that drives you? What are you so passionate about this? I mean, you're just closing your remarks there sounded so generous and a sense of abundance and, playing in this field. So what is it that inspires you to do what you do?
Well, there's a few things. Primarily my work ethic. I can't. So I was brought up in a Catholic high school, and what we were taught at the time probably isn't taught today, but that you were given certain gifts by God, and that if you do not use them, it's a sin. The greatest sin is to be given gifts and not use them. And so I think I have a gift, and so it's what I do. As far as being in an environment where you want to help people, I think that if everyone in society reaches a certain level, then we're all better off for it. We don't need to take everything off the table and then watch people with nothing. Nobody wants to live in that place. So, yeah.
Aurelio, I love this, even philosophically, having this conversation with you and having this conversation with all of our Real Estate Wealth Lab members and potential members. So come on out, because this is the type of community that we are. We're a win-win. And as Jay, you've heard me say this many times, collaboration over competition. We're all in here to really help each other out. And by example, there, you just said it. So, and to use your gifts. I love that. So Aurelio, thank you so much for your time today. Thank you for your generosity and sharing, a lot of details about your business and how it runs and all of that, and answering some fantastic questions. Ladies and gentlemen, if you want more of this, pop it in the chat. What kinds of conversations do you want? What other topics do you want to learn about? Please contact us at info@realestatewealthlab.com. And if you have not joined our community yet, if you have not joined our free trial yet, absolutely, please join us. It's and it's at realestatewealthlab.com. So thank you. There it is. Thanks, Paige, for popping that in. Thank you again, Aurelio, and I think we'll close it out. So
thank you.
Have a wonderful evening, everyone.
Bye-bye.
Bye.